Hi, I'm Shamez Kassam. I'm a registered portfolio manager and chartered financial analyst in Calgary. I saw a great article in the Globe and Mail yesterday talking about how the Toronto Stock Exchange has had a great year performance wise, but sadly, many Canadian investors are lagging behind. One of the reasons is because of the way many Canadians invest. When you invest, you have choices. One of the more common ways to invest is to use low cost exchange traded funds, ETFs, that essentially give you the benchmark return. So you get the TSX return minus a very low fee, which can be zero point zero 0.05 or zero point 0.1, something like that. However, many investors choose to use actively managed mutual funds whose goal it is to actually beat the benchmark. And to do that, they do charge a higher fee because they have to employ lots of people. Now, here's where it gets interesting. All the data consistently shows that over a 10-year period of time, the probability of any actively managed mutual fund beating its benchmark is exceedingly low, like less than 10%, perhaps even less than 5%, depending on the category. This year, many Canadian equity actively managed mutual funds have underperformed because they've been underweight gold and materials companies that, for a large part of the year, did quite well. Now, that might be reversing a little bit now, but nonetheless, the point is these actively managed mutual funds were underweight one of the big TSX sectors. In my opinion, all mutual funds are not bad. They do have room in a portfolio in certain areas like small cap stocks or international stocks where markets are a little bit less efficient. In my opinion, the core of any portfolio should be low cost index funds, exchange traded funds, precisely to avoid the problem that was in the article. If you want to get a second look on your portfolio, I highly encourage you to click the link below. Doesn't cost you anything, just a little bit of time, and at the very least, you'll walk away with some great information and education. See you next time.